Well, for some reaction to the September ADP jobs report that just came in, worse than expected, losses across the board. Stephen Levitt is with us. He's the author of the best-selling book, Freakonomics. You might have seen that in your bookstore. The film version was released just last week. Levitt is a featured speaker today at the World Business Forum here in New York, where we were yesterday, and he joins us live from Radio City Music Hall. Stephen, great to have you with us. And I want to get your perspective on this jobs data, because, you know, your book is all about incentives, right? And what happens, what a small event might happen and how that has unintended consequences. Now, we know the government put in all the stimulus money in order to have this one consequence, which is to create jobs. It hasn't, at least not to the extent that the American public would like. So what happened here?
Well, you're asking me harder questions than I'm used to answering, because I'm a microeconomist.
Oh, come on, you're an author. No. You're not going to get away with that.
I mean, I think the simple facts are that we don't know what would have happened if we hadn't done stimulus. But at the same time, you know, most economists, I think, were never that optimistic that government was going to be the answer to this problem, that stimulus was going to have a big effect. It's been hard to spend the stimulus money. A lot of it's probably spent in ways that haven't created a lot of jobs. So I don't know. I guess if you had gone back and asked my, you know, free market colleagues at the University of Chicago a year or two ago whether the stimulus was going to have a big impact, we would have said probably not. That if we were in charge, we would have tried to maybe stimulate free market investment, you know, through investment credits rather than having the government spend the money directly.
Right, and some people are talking about that now, that maybe that's exactly what's supposed to create jobs. I mean, have you found in any of your research, as some are arguing now, particularly Professor Barrow there at Harvard, that the money that is used to extend jobless benefits, let's say, actually disincentivizes workers to find jobs?
Oh, well, I mean, I think that's clear, that if you pay people more not to work, they're going to look less hard for jobs. Now, that's not saying it's the wrong thing to do, right? There's the trade-off efficiency of getting people working with equity of the true hardships that people who are unemployed, unable to find jobs are facing. I mean, we believe in a safety network, but it's simple economics to say that if you're going to make it you know, more painful to be unemployed, people will look harder for jobs. I mean, I don't think any economist would disagree with that.
Well, no, there's a lot of I think there's several economists who disagree with that, though, Steve, because I mean, why else did Congress pass the extension of the jobless benefits?
No, I think it's because you're trading off. If our goal was to have unemployment as low as possible, we would have no unemployment benefits. We would have people who are unemployed would be out scrounging. I mean, they would do anything to get a job. Now, that wouldn't be the right way to run the country. It wouldn't be a good thing that people would suffer like that. But it's a trade-off between getting people to work and of the people who, because of misfortune and bad luck in the bad economy, are out of work. We try to take care of them, because it could be, you know, it could be me and it could be my children, and we feel empathy for people who are in that situation. But on the other hand, there's no doubt that, you know, let me give you the extreme case. If you made the unemployment benefits $100,000 a month, everybody would be unemployed, right? So it's just you know, so it's just to a smaller dimension. That's what you do when you make these benefits more generous. But I just want to emphasize that doesn't mean it's wrong to have generous benefits. It's just a different, you know, you're trying to solve different problems.
Right. Okay. All right. Let's move from the jobs market, Steve, to the stock markets. You write about in your book also about this idea of fear, you know, and how that drives people. I think you used an example of the Chicago public school system and how fear kind of drove, in some ways, teachers to cheat. Okay. So fear in the markets right now. How do investors overcome that fear to get back into the markets?
So you're asking me all the questions that I couldn't possibly know the answer. If I knew the answer to that, I would be doing something other than what I, you know, piddling around at the University of Chicago.
You'd be writing a second book. Come on.
Complete mystery to me. If I knew anything about investing, I'd be a rich man. So I think it's just, you know, I'm not sure people shouldn't be afraid. I mean, my view is when things go up a lot, you should always be afraid, right? It happened with housing. Housing went up a lot. We had no real understanding why it did, and it came down a lot. A lot of the times when the stock market goes up a lot, right after that it goes down a lot. I don't know. I don't see any good reason why the stock market went up as much as it did. I'm happy it did. I have money in the stock market, but I'm nervous. I'm fearful, so I'm not sure why other people shouldn't be either.
Right. Well, I think you're in good company, and I've been corrected by my producer. You have written a second book, so I apologize for that mistake. But Steve, okay, let's just move. Okay, then all right. So if we want to move from the markets, then talk about information asymmetry, right? You mentioned that in the housing market. At the very least, though, you must be able to tell us, though, in the housing market right now, people are always looking for the good deal, but the buyers aren't going back in. Is this information asymmetry? Those who know more about the housing market than those who don't. Is there any way to get that moving again?
Yeah, I don't think I wouldn't describe the housing market right now as being about information asymmetry. I think it's just the prices got really high, and people looked at housing as a way that, even though it was expensive, they thought it would go up, therefore it's a good buy. Now people don't have a lot of money, and they think that housing might go down further, and in fact there's every indication that housing prices will go down further. 20% of people in default on their homes, there's going to be lots of foreclosure. So I think we're kind of bumbling our way towards an equilibrium in the housing market. And it's not clear whether the prices are going to be higher or lower, but I doubt that we're going to see the massive price increases that we've seen in the recent decades. So
no, that seems
again,
to be
I think people should be fearful.
That seems to be over with.
Yeah. I mean, I think people should be fearful and and cautious, because they should have been cautious the first time around too. And a lot of people have suffered a lot. Of course, a lot of people benefited a lot, right? The prices went up. Somebody was on the happy end of that, selling their homes.
Right.
But yeah, so I think that people are rightfully cautious because we're in a very uncertain time.
Okay, all right. Steve, thank you so much for joining me.